All right, let's switch the conversation a bit here and let's discuss the elephant in the room. We at CPI Capital, we've been talking trash about the Canadian multifamily market for years now. So the low rental yields, negative cash flows, the rigid mortgage laws, and the high cost of material and labor, and most importantly, the investment culture that I always speak about, where Canadian passive investors are much more conservative. They're hyper cautious than their U.S. counterparts. So peak multifamily has seemed to have just leaped over these hurdles and is flourishing. Yeah. So tell us about how you achieve success in this sector that has such slim pickings. The Canadian multifamily private equity sector.
Okay, so I have a quick question for you. What do you find so negative? You say you're trash talking the Canadian market. Is it the ability to source deals?
No, I just listed them. So for example, some of those issues are they're low rental yields. So rent to value ratios in Vancouver and Toronto are much lower than they are in the US. In most cases, if you do a conventional mortgage, put down 30%, borrow 70% from the bank, you're in extreme negative cash flow. So that's one concern. Whereas in the US, particularly in the Sunbelt states, the rent to value ratios are high. You could put down 30%, you'd be well into cash flow. So offering that when it comes to a syndication model, your investors are receiving cash flow, where in Canada that wouldn't be the case and cash flow becomes non-existent. The other issue is mortgage laws. I mean, in the US, they're much more business friendly. The ability to get mortgages is much easier. You also got tax benefits on the US side when it comes to depreciation and cost segregation and bonus depreciation. Just the process. And then again, the last point was the culture. The Canadians are very hyper cautious. They're very conservative. Ava has to be on multiple calls, in-person meetings before somebody kind of invests with us. Whereas our US investors, we say, hey, how you doing? On a first call, what's your minimum? Is 25? Okay, I'll invest 50K.
When can I transfer the funds? I'm like, I just talked to you for 10 minutes. What are you talking about?
So those are the kind of concerns that we've seen. Also, like the market, the U.S. is over 300 million people. There's an interstate migration happening. The kind of job growth and population growth that exists in Texas and other states. You're not relying on people coming from China or other places in your economy. Something happened, like in Vancouver, being a real estate guy here, something would happen in China and would affect our market here. So in the U.S., you don't have those concerns, or not nearly as much. So I mean, the list goes on and on, but and also like on the property management level as well. U.S. property management firms manage your property, manage your leasing. They also do the renovation. Not a single property management firm ever in Canada that I've heard of that does management and renovations. So just so many different.
But talk to us, guys, because we have lots of Canadians that want to invest in their own backyard. So that's where you guys come in, right? So.
So I'll touch base on the financing first of all. So if you're typically, and there's so many different tools. So if you're typically doing a lot of the deals that we're doing with conventional financing, you're right, it doesn't work. Right. But what's typically happening is, say we're in a market that a conventional lender will look at it and lend at a 5% cap rate. What's happening is all the purchasing going on is typically around 3.5 to 4. I would even say more of a turnkey product with not much value add, say 4.25, right? But the lender's lending at a 5 cap. So yeah, you have to put 50% down when you're doing conventional. But there's a lot of lenders out there, which we use, that they understand the market. They're taking on a little bit more risk. Yes, interest rates we're paying are in the 5% range, but they'll do 80% loan to appraised value. But typically the appraisals are coming in at that 3.5 cap, right? And because you have, not in all cases, but because you have that lender that's a little bit more flexible, more of a private lender in terms, they're allowing a second on it. So one of the last deals we did, we went 90% loan to purchase, right? So we're in with very little money. Now, yes, it's negative cash flow for sure. We're structuring our second as a balloon, but the actual rent spreads, like one of the other buildings we bought in Hamilton, we ended up turning 18 of 19 units in the year. I think the average rent was $780. We're now getting $1,950 for twos, $1,650 for ones. So yes, we bought it at a low 3 cap, and now it's going to be appraised at just over a 4 cap. There's a lot of value to be had, right? I'm not super familiar with the market in the States, but I don't think you're seeing $1,000 plus rent spreads where something's rented for 700. If you get them out and renovate, you're now getting $1,000 a month plus.
Let's talk about get them out. Let's talk about that subject briefly. So in all the states that we invest in, and they're reds, the Republican states, red states, there are no rent controls. Talk to us about the rent control concerns or other issues that exist here as well.
Yeah. So when you're talking about, and this comes down to the underwriting at the beginning, when you're talking about $1,000 rent spread, and you know that your appraisal for a turnkey will come in at 4.25 or less, depending on where you are in the transition. Mark, what if you can do it quick? Just $1,000 a month times 12 divided by, say, a 4 cap in the markets typically that we're in. It's got to be 280, 290.
Yeah, 300.
300. So you're factoring in, say, a $50,000 renovation. If we have to factor in, and sometimes, like when you're talking to tenants, they want to move, right? A lot of the building is run down. They don't really want to be here. They moved in, it was cheap rent, and they've wanted a way out. So we kind of take that approach to say, we do want to renovate. We want to help you along the way. We're willing to compensate you, and we'll take them literally by the hand and have a leasing agent show them other properties. And sometimes, like, say they're paying $700 for that particular unit, a very comparable unit is maybe $1,100 now, not renovated, right? So they're going, okay, $400 more. What should I do? But if you were to offer them, say, $25,000 to leave, they may say, wow, this is going to cover my rent for some time, or this is going to allow me to put a down payment on a house because my income's there, I'm trying to save. So yeah, it costs you, say, we've never had to pay 25,000, by the way, but I think the last one we paid 20 was the highest we've paid. And it was actually a $1,200 a month lift. She was paying 7 and change, and we're getting now $1,950. But yeah, 50 for the reno, 20 to leave. You're still getting that value of $200,000.
Sorry, Mike, right? You're paying $20,000 to someone who leave a unit?
We have. That was the most we've ever paid. But the lady was paying.
American friends are like right now, our American friends, or whoever will watch this video, like that will just blow their mind. I mean,
but it's like, so, but if you do the math, so it's like, okay, so 20,000, let's say a $40,000 reno. So you're investing 60,000 to get a lift of about 320. So that's how we do our math, right?
The economics makes sense. The numbers make sense. I totally understand that, but I'm talking about a system that's made for the entrepreneur to fail. The system is against us. You got to understand that's the difficulties that we go through here in Canada, not only on the kind of entrepreneurial scalability, but also on the taxation and the highest tax bracket. I mean, so many different issues that exist. I'm not sure how much more you guys want to chat about this topic, but we'd love to keep talking to you guys about it.
I think like anything, there's trade-offs, right? Like I think the ROIs that have been achieved, and again, there's like billion-dollar REITs that continue to buy in this market and buy in the US, but their portfolio is still skewed towards this market. It's risk and reward. I think the buildings that we're turning over and the strategy has generated 30 plus annual returns on these buildings, which I think is a pretty good return for the building. So this one that Mike's talking about even more because we've been able to turn so much. But yeah, there's challenges that you have to overcome, and I think we built the system that's enabled us to do that. You're right. We're buying properties that don't cash flow out of the gate. So that's got to be factored in, right? So there's a lot of capital expenditures, but when it does, when we do turn it over, there's market appreciation, which I don't again, not so familiar with all the markets in the US, but I don't think you see the market appreciation that we see here in the US. So there's the equity growth that happens, and I think a lot of the people that we partner with, they're professionals, professional income, so they're not looking for cash flow right now. What they're most interested in is putting their, the capital in a safe asset that's less volatile, so you don't have the volatility. But they know that the equity is growing because, again, we're in a market where immigration is a big part of it, as you mentioned. Population's growing, and rents are double-digit rent growth, at least in the markets that we're in. So again, we're specifically targeting markets that have good transit, have population growth, and have experienced double-digit rent rate increases every year.
We love it. We love it.
And I wanted to touch base on the $20,000. That you do get natural turnover. Typically in any building over a 5-year period, you're probably getting 25 to 50% natural turnover, right? Then you're having these tenants who want to, leave. You cover their moving costs, they're going to leave. It's the one-off that you're paying that much here and there, and they're willing to say, yeah, I know, like they're very appreciative, the tenants. Thanks a lot. Like, this is going to help us go a long way. But it's not every tenant we're paying $20,000, right?
Well, just like Mark said, the numbers make sense. Even if you had to pay it, as long as that's part of your pro forma, if it makes sense, it makes sense. Totally. For us, certain other capital expenditures make sense. This is the same kind of concept. I was looking more as a young entrepreneur, or maybe not young so much anymore, but I felt like the Canadian system was made to make young entrepreneurs fail and is to dismotivate from people to become entrepreneurs, and at so many different levels. And in the US, I've had so many professionals who've made the move from Canada to the US, and they're like, you guys are crazy spending any time there. Move to the US. We plan to move to the US. Obviously, we always keep our Canadian roots and heritage, but if you want to do business and you want to scale your company and your business, the US is the place to be. And you can see that with so many other companies around the world that have
But for our conservative Canadians who want to invest in their own backyard, we would love to do a deal with you guys, because you guys really know your stuff.
Definitely.
And I just want to touch base. Mark brought it up quickly. There are REITs in Canada that own 20 billion plus of assets, and say 5 billion is in the US. And you wonder, how come they're keeping 75% of their portfolio in Canada? And you start digging deeper, there's got to be reasons. It's not like they don't know about the States. They're holding, $5 billion worth of multifamily in the United States. Why in Canada? Right? There's got to be something.
On the reverse of that, as I'm very active on LinkedIn, I see a lot of other larger private equity firms who are switching to investing in the US, where in the past they never did. So there's also a transition happening on that side as well. Again, the conversation doesn't need to be about which one is better or not. I think we've easily won that debate.
Oh God!
But the thing is more about having a business model in the region you're on and being successful in that business model. That is the key, and you guys have achieved that. Doesn't matter how you achieved it. If you achieved having to pay someone $20,000 to move out, doesn't matter how you achieved it. It's all about returns to investors, profits to investors, and managing a great company with the same business model that we utilize in the US, and you've been successful at it. So all the kudos to you guys.